In this episode, we walk through the financial impacts of a major life event and debut our new change of plans checklist. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello and welcome to another week of the New Money, New Problems podcast. I hope that you enjoyed last week's episode. It was to me one of my favorites, my wife's money story. We've had, thankfully, a good uptick in listeners at the New Money, New Problems podcast in recent months. And when we're trying to introduce and share a little more background about who I am, where I came from, ironically, my wife's money story is one of the episodes that I think is a great way to do so. This week is a little bit different. We are going to be doing a demo of a resource that we've been working on to put together over the last few months very diligently, and that is our change of plans checklist. And I want to give you a little bit of background about why we came to this checklist. We're going to put a link to it in the show notes. It's newmoneynewproblems.com/change of plans. And we first thought of this checklist after our episode with Tony Collier. If you don't recall, and we'll link to that in the show notes, the Tony Collier episode is with the renowned author, YouTuber, podcaster, and she has been going through an intense period of change in her life in recent years, coming off of her second divorce, which was very public, with a lot of things that are just things that you would rather keep private. She was navigating being now a solo parent to 2 children. She was shelving a book and then rewriting a book based on her experience, all doing this at the same time. And it reminded me of something that my father actually introduced to me at a time when I was having some serious anxiety, panic attacks, following a series of events that were all technically positive. I remember being 25 years old. I was about to get married. We had just were trying to close on our first home. My wife was moving out of her apartment into our house, but there was like a 3-day lag where we had to figure out a place to put her stuff before we moved into our house. I just bought an engagement ring. I had just started a new firm. All of these things on its face were positive. And I remember driving and getting a call from our mortgage lender that the closing costs that they thought were going to be $5,000 were actually going to be $10,000, a $5,000 increase of money that I didn't have. And I remember having a full-on anxiety attack. I thought I was having a heart attack, and I called my dad to tell him that I was dying and ask if he had any life-saving advice. And after I calmed down, he introduced me to this stress scale called the Holmes Rahe stress scale. And the premise of this scale is that we often think of positive events in our life as things that we should have a positive reaction to, when in reality, everything that we do, positively or negatively as a life event, it has an impact on either our stress, and in the case of New Money, New Problems, our money. As a matter of fact, if you look on screen, I have the Holmes Rahe life stress inventory, and it has some negative events in life: death of a spouse, divorce, marital separation, and it assigns a point value to those events. But you'll also see that there's a point value associated with things like marriage, things like retirement from work, things like pregnancy, things like a major change in your financial state, positively or negatively. And if you look at the scale or the scoring system, it shows you that if you have life events that total up to a score of between 151 to 300, whether they're positive or negative, you have a 50% risk of a major health breakdown in the next 2 years. And a score of 300 or more implies an 80% risk of a major health breakdown in the next 2 years. So we can see that there is a mental and physical impact to our lives when we have a life change, whether it's positive or negative. And in thinking through Tony Collier's story and reminding myself of that time in my life, it called to mind the importance of letting people know about the financial impacts of life events, be they positive, be they negative, be they large, be they small. thus the creation of the change of plans checklist. So in this episode, in the first half, I'm going to walk you through kind of a breakdown of how the checklist works. In the second half, we're going to take a life event that is one that I would consider a major life event, that's a stressful life event, and walk through in the checklist how it identifies the areas of your finances that are potentially impacted and what you should do to go about reacting or adjusting to those changes. If you're looking on screen, we have the change of plans checklist on screen. We have a test case. We're using Ron Swanson as our test case. If you know that reference, I assure you that you are good with me if you know the Ron Swanson reference. But once you put in your email address, it will reload to the first page of the change of plans checklist. And this interactive checklist will first show you a financial table of elements. There are elements of your finances that are impacted by different life events, be it taxes, investments, insurance, employee benefits, estate plan, and student loans. And when you check off one of these life events on the ensuing pages, it will highlight which table of element is impacted. You'll also see an urgency level for each life event. Yellow life events mean you may be able to handle this yourself. Orange life events mean it may be helpful to contact a specialist. A red life event means, in our opinion, seriously, you shouldn't try this without the help of a professional. And there are 8 different sections and 52 life events in total. On family structure, there are things like the change or potential change in marital status. That's what we're actually going to tackle in the second half of the episode. We're going to talk about the impact of a divorce. You'll see things like death of spouse, preparing for adoption, even things like change in the status of spousal support. On the home ownership tab, you'll see things like buying a home out of state, damage to a home or planned repairs or renovation, buying or refinancing a home. In the health section, you'll see things as major as the terminal diagnosis of yourself or a spouse, and things as seemingly minor as a weight loss greater than or equal to 10% of your body weight. On the page where we talk about children, there's things like the identification of special abilities or learning differences in a child, having children with unearned income, and the planned major support for a child through things like home purchases, student loans, and financial gifts. There's an employment section where we talk about having a change in employment status, but even having the eligibility for a bonus or consistently working overtime hours. On the page for student loan borrowers, there's changes like the change of employment status in terms of a nonprofit or government entity, having private student loans, being a co-signer or having a co-signer on a loan that you've taken out for your schooling. And then on the equity compensation page, there's questions like, do you have a company where you're within 90 days of an exit with unexercised stock options? Do you work for a company that has gone or will go public? In the last section of estate planning, there's life changes like establishing a will or a trust, having a change in preference for persons or terms relevant to your estate plan. And the good thing is when you click off some of these items and you highlight them, you'll be able to view a summary of those life changes, the urgency of those events, and even be able to download a full resource document that goes into more specific detail about the things that you might do to adjust to these changes, and also additional resources to read more about that impact. So after the break, what we'll do is we'll tackle one of these items, that item being a pending divorce, and we'll walk through some of the financial impacts that the checklist identifies and some of the additional resources that it will provide for Mr. Ron Swanson.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
All right, as I promised, we're going to choose an admittedly negative life event. In this example, we're going to assume that Ron Swanson has gotten divorced from Diane Lewis. Again, if you understand the reference, we are immediately friends. And we're going to click change or potential change in marital status. And you can see immediately that this is an orange life event. And by hovering over the color, it will show you that it would be helpful to contact a specialist. And will also show you the table of elements. And the first thing that you see on the table of elements that's impacted by this life event are taxes. So what are some of the ways that you are impacted by a divorce in terms of your taxes? Well, the first thing is typically a divorce is preceded by a separation. So when we have an unfortunate situation where we have a new client or current clients who are separated and moving towards divorce, but it has not been finalized, I would talk to a tax professional about filing separately. There are various reasons, even though it could lead to potentially higher taxes. If you have a spouse that has an admittedly more complex tax return than you, filing separately could in some cases shield you from liability for the activities on that spouse's tax return. Is this a recommendation to do it? Not necessarily. It's a recommendation to consider it in consultation with a tax professional, and the process itself is something that, in my opinion, necessitates a tax professional. If I were going through a separation and impending divorce, I would not be filing my taxes on my own. Now, let's assume that the divorce is finalized. When a divorce is finalized in the following year, you can no longer file as married filing separately or married filing jointly, regardless of how beneficial those tax brackets may be. You have to either file as single or as head of household. That is, depending on your income, something that can greatly impact the amount of taxes that are owed. And if you're a high income earner, especially if you're someone that has equity compensation or bonus income that is being withheld at a lower rate than your tax rate, you certainly want to walk through the tax impact that could have, because single and head of household tax brackets are decidedly less forgiving than married filing joint tax brackets. So if you're getting a tax bill or owing in a typical year when you were married and you're a high income earner, it is almost certainly something that you're going to deal with at a higher level when you file single or head of household. So having a proactive plan following the finalization of a divorce is something that's incredibly important. The next element that you'll see on the financial table is insurance. So let's talk through some of the impacts of insurance when it comes to divorce. The first thing is when the divorce is finalized, or potentially even when you're in a separation, you want to do a beneficiary review. And this is something that will come up with investments as well. When it comes to things like life insurance, there are scenarios where divorced spouses still leave their former spouse as the beneficiary of their life insurance, especially if they have minor children and they trust that former spouse to be over the finances of that child. But if you are not in that situation and your wishes have changed, you want to go through a beneficiary review of your individually owned and your group life insurance policies, because it is very common for us to look at someone who has insurance policies and divorced many years ago and see that they still have their former spouse listed. There are also some individually owned disability policies that have a small death benefit associated with them as well. And however obscure that may seem, it is something where you still have to name a beneficiary of that policy. For those who have group policies, in addition to checking the beneficiary on that group life insurance policy, you may also be paying for spousal life insurance. That's not typically something that you can cancel in the middle of a year after you've made your elections. But the thing about a divorce is it's what's considered a qualifying life event. If you have a qualifying life event, you have the ability, even when you're outside of what's called open enrollment, to go and modify or change your employee benefits. That includes not only things like spousal insurance, but it also includes the structure of your health insurance. If you finalize a divorce and you have health insurance where you may be paying for a family plan for your children and your now former spouse, you can amend that plan through a qualifying life event and change it to a plan that's a lesser expense to pay for maybe just yourself or yourself and your children. This will likely require some form of verification, which could be a divorce decree or what's called a domestic relations order. And a domestic relations order, some people will call it a qualified domestic relations order, is essentially a document that lays out all of the terms of the divorce, not just in terms of things like custody and division of marital assets, but also for things in terms of just verifying that a divorce has occurred so that you have proof to change things like your insurance plans. Moving on to investments, there's a great impact when it comes to a divorce on your investment portfolio or that of your former spouse, and much of it is handled by that domestic relations order. So for example, let's say that you have an investment account that is a joint tenants with rights of survivorship account. That means that as of right now, you and your spouse are equal and undivided owners of that account. And if you are still married, there's really not much that can be done to restrict that partner's access to that account. That's the point of being equal and undivided owners. But in the event of a separation or divorce, you can have, through that divorce decree, a freezing of that account to restrict the ability to change investments or make withdrawals without the consent of the other spouse or even the judge in some cases, until that account can be separated and each spouse's portion of the funds allocated to individually owned accounts. There are also scenarios where you may be granted a portion of an account that's not currently yours. For example, you may have been granted through your domestic relation order a portion of an individually owned investment account from your former spouse. And without that order, it's not something where you can just go to the company and say, hey, they said I'm owed $50,000, cut me a check. You have no legal authority to that account. But with the domestic relations order, you can go to the custodian of that investment, and with that document, they will have the legal ability to disperse the amount to which you're entitled. And this is also true with retirement accounts. With retirement accounts, there are very little recourses in terms of being able to distribute money to someone that's not the listed owner of a retirement account. But a domestic relations order is one of those allowances where with that document, a retirement account record keeper can take money from, say, Ron Swanson's 401k and distribute it into a retirement investment account that's in Diane Lewis's name, or they can send a check to her directly, although in that scenario, it could be treated as an early retirement distribution depending on the age of the recipient. Next, we'll go to estate planning, and estate planning is another area where, yes, a beneficiary sweep is important, but there are also some additional elements that you need to consider. For example, it's very common for your spouse to have your financial and healthcare power of attorney. That may be something that you would consider changing even in the event of a separation before a divorce is finalized. So a person you're about to divorce doesn't have the ability to make financial and health decisions on your behalf. But post-divorce, there's a difference between things that are voided and things that typically need to be addressed. For example, with a will, and you would need to confirm this with an estate planning attorney in your state, it is not uncommon for any gifts to a now former spouse to be voided after a divorce. So if, for example, in Ron Swanson's will, it currently says that all of the gold that he possesses is going to go to Diane Lewis, after their divorce, that planned gift may be voided even if he hasn't revoked the other elements of that will. Now, this isn't true while separated, and this speaks to the importance of handling things even in the midst of what you're going through, because if you have not currently divorced and you were to pass while separated, it may not be the case that the planned gifts that you have to that spouse are voided. It would be something where that person may be the recipient, and this is also something that we've seen where a spouse in the midst of a separation passes and the recipient of their life insurance or their retirement account is that spouse from which they were estranged. When it comes to things like a trust document, however, it's likely that you would need to revoke or dissolve that trust because in addition to maybe having planned gifts to a spouse, they are likely also the trustee of that trust in addition to you. So in most cases that I have seen, an attorney is going to recommend the dissolution of a trust, revocable or irrevocable, in the event of a divorce. Lastly, student loans, and depending on whether they're federal or private student loans, you would be surprised at the impact that this can have. I'll walk you through just some of them. First, covering the importance of having it addressed in the domestic relations order, and I can tell you, you'd be surprised how often divorcing spouses forget to include student loans when it comes to the discussion of assets and liabilities. Speaking to private student loans, it is very common to have one spouse co-sign for the other when it comes to a private student debt. I have seen situations where a couple has divorced and there's a student loan that my client co-signed for their former spouse to go to college. They now have an equal responsibility to pay that debt as a co-signer, even if it wasn't for their schooling. Now, if addressed in the domestic relations order, it's possible that there could have been something done to release them as a cosigner, and many private student loan carriers offer cosigner release for various reasons. However, in this case, the domestic relations order did not address it. There was not the option to have them released as a cosigner, and the former spouse was refusing to pay their own student loan bill. They were avoiding it completely. And as a result, not only was their credit ruined, but the former spouse's credit was ruined as well, to the point that they had to make the decision to pay off their ex-spouse's student loans or risk destroying their credit for years and years. That's not something that you want to occur. When it comes to federal student loans, it could be a negative impact that you wait until your student loan servicer catches on to, or it could be a positive one that necessitates you reaching out to your student loan servicer immediately. Here's an example of both. Let's say that you have federal student loans and you pay them back using an income-driven repayment plan that's based on the income of you, the people in your household, and the number of people in your household. And let's say that you're an extremely high income earner and you have a spouse that's a low income earner, which yes, that means their income is included in the calculation, but you also get to include them as a person in terms of the federal poverty level that's used to reduce your student loan payment. Well, you may find in that scenario that it's worth waiting to alert your student loan servicer or having them find out on their own when they pull a tax return that lists you as single, because you may run the numbers and find out that as soon as your spouse is removed, it will actually increase your student loan payment. But this also works in reverse. Let's say that you're married to someone and they earn a significant income and don't have federal student loans. Well, that means, especially if you file your taxes together, that their income is increasing your student loan payment, and you may get immediate relief by notifying your student loan servicer of your divorce and letting them know that they need to recalculate your payment. To give you an example, let's say that we have a couple that has an adjusted gross income of $150,000. $50,000 of that is the person who has the student loans, and $100,000 is allocated to the spouse, and they have 2 young kids. Well, if they file their taxes together and they pay on the new income-based repayment plan at $150,000, that's a payment of $848 a month. That's no joke. Now let's say that that couple divorces and the person who has federal student loans still has a $50,000 adjusted gross income. They call their student loan servicer, they tell them about the divorce, they ask them to recalculate their payment, and now they have a student loan payment that's based on just their $50,000 of adjusted gross income and the 2 children that are in their home, and it knocks their payment from $848 a month all the way down to $84 a month. A decrease of almost $800 per month just by being aware of the potential impact and reaching out and acting accordingly. Now that we know the changes of that one life event, let's assume that there are some other things that this person is going through. They've gone through a divorce, so maybe they're deciding that they're going to move and buy a home out of state. I think we'd all agree that we've seen people get divorced and lose a few pounds as they get back into the dating marketplace. So let's assume that they have a weight loss greater than or equal to 10% of their body weight. Maybe the employment section, they have a change of jobs, and in that job, they're eligible for a bonus. And let's also assume that they have private student loans. Under estate planning, we're going to choose change in preference for persons or terms relevant to your estate plan. And now we're going to view the summary. You'll see that in the summary, it has the number of items selected, 7. 4 of those were lower priority that this person may be able to handle on their own. 3 are medium priority where a specialist may help. And we're going to download the full summary with resources. And in opening up this document, you'll see a 4-page PDF that goes through each change, and it gives not only a detailed breakdown of the potential things of note, but it also, in many cases, gives additional resources, either through articles and documents we found online that we think are relevant, or in many cases, resources we've actually put together, be it a calculator, a podcast episode, or even an article in which we've been featured where you can read more about the impact of that item. So this is a wonderful resource that we've put a lot of work into that we think you'll benefit from, even if it's a life event that you don't think is as big as we're leading you to believe. So again, you can go to newmoneynewproblems.com/change of plans, and you can go through this checklist on your own. We'll put a link to it in the show notes. I can tell you that I try to be measured when I talk about things that I believe are valuable. This is one of those things from which I think you would benefit. So I highly encourage you to check it out for yourself. If you have a friend or family member that's been going through a number of changes, send it to them as well. And we look forward to seeing you right back here next week.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.